Well, we've got a pretty good crowd already. So I would say let's go ahead and we'll kick ourselves off. So thank you everybody first off for participating and joining today for the for our investment committee meeting for the Science of Mind Foundation with all the centers. So I know all of you are participating in the Science of Mind Foundation, and we're the investment committee here. You've got represented today. So we want to make sure that, again, this is a good meeting where we can have plenty of interaction, answer questions. But we did want to really start off today going through just some background on, how did the Science of Mind Foundation come to be? We've got, we're fortunate that we have Ray Marvin and Dr. Ken Gordon on our investment committee that have a very long-term background in the Science of Mind Foundation. I myself have been working with the investment committee for the Science of Mind Foundation now for almost the past 10 years and did serve as a board member for about 6 of those years as well. So hopefully we can give you some context around things and how everything really got set up and started, and provide some information about the portfolio itself, performance, why we're set up the way that we are, and how this is grounded in the Science of Mind teachings. And so first off, I'd like to go ahead and maybe start us off with prayer. And since we have so many folks on with us here that are wonderful at this, I wanted to open this up and ask if anybody would be so kind as to ground us in prayer to start off our meeting. Are there any volunteers? Yes.
Reverend Michael.
I would volunteer. So just invite each of us and all of us to come together in a moment of feeling into our breath and allowing that breath to take us into that presence of Spirit's breath, that presence of Spirit's breath, which is always guiding us and gifting us and gracing us. And I know that today that breath of Spirit becomes our voice of Spirit as we each speak our questions and our answers, and everything that needs to be heard today is heard. Everything that needs to be answered today is already answered. And together we come together in raising up and praising up and amazing up in that wonderful energetic field of love. We come together in that one heart of Spirit as one in our heart, and knowing that love is the flow of all energy. Love is the flow of this energy today. And love is the gift of presence that each and all of us are. And I invite us together to say, and so it is.
So it is.
Wonderful. Thank you so very much for that. Very much appreciated. That was wonderful. So I'll start off with some introductions, and then I'm going to go ahead and hand it over to Michael. And so, but first off, I'll introduce myself. So my name is Arrow Johnson. By profession, I am a senior investment advisor for foundations and endowments. I've been in the industry somewhere close to about 28 years here at this point, and have been working professionally for foundations and endowments as an investment advisor for the vast majority of that. And joined on the board by some really phenomenal folks who I think most of you know very well, or at least know somewhat. And so that's Dr. Ken Gordon and Ray Marvin. We also have a 4th member of our investment committee, and that's Charlie Goldsmith. And we've been working together. We had originally the Finance and Investment Committee, which broke off specifically to the Investment Committee. And we are a subset of we're one of the committees for the Science of Mind Foundation, specifically tasked with looking at the investments themselves, helping to formulate the investment policy statement, doing due diligence on an ongoing basis. We meet every month or every 2 months as needed to go through the performance, to talk about the structures, to meet with our investment managers, and to report back to the board. So we've been doing this now for, again, the better part of, I guess, about the last 11 years now. And we've had investments being professionally managed we're coming up on 10 full years here in September of 23. So we've got a good long-term track record. and a lot of success. And it's been a relatively new development over about the last 5 years in working with all the centers. So we're thrilled to have so many centers participating, being part of this process, being part of the success on a long-term basis alongside the Sign of Mind Foundation. So again, welcome to everybody. Thank you for joining us today. I'm going to go ahead and hand it over to Michael. He's going to be our MC for the meeting here going forward and with questions. And again, I just encourage everybody to please ask questions in the chat, I guess, first and foremost. And then, again, we'll have plenty of time at the end for the questions that are coming up as well. So with that, I'll hand it over to Michael. And Michael, our executive director, will please not forget to introduce Michael. Michael is a core part of all of our investment committee meetings, as well as all the committee meetings for the Science of Mind Foundation. And he's just a phenomenal person to work with, really responsive. Peggy is on the staff as well, and we just get so much support and help from them. So let me go ahead and I'll hand it over to Michael.
Well, thank you so much, Arrow. I really do appreciate that. I am Michael, and Arrow has already told you a little bit about our staff. There's two of us. The other one is Peggy Keynes, and Peggy is our manager of operations. So you are always welcome to contact either one of us on any questions that come up. And without further ado, it is at this point that we will move through our agenda. We hope that this meeting is going to be about an hour long, but we definitely want to get to all of your questions. So if you do have those, again, as Arrow said, put them into the chat. And so it is at this point that I would like to turn this over to Dr. Ken Gordon.
Thank you, Michael, and thank you, Errol. Boy, it's great to see all of you. I haven't been in a meeting for a long time, and I see so many friendly faces. It's wonderful. The foundation was a great idea that was birthed at the same time as we entered into integration. It actually started a couple of years beforehand in conversations that were going on, and the realization that not just as an organization, but as a consciousness level of our centers, is that financially we needed to grow and expand and build into a greater and a larger form of belief system than what we'd previously had. And I can remember Steve Burton was the real instigator for it. And he was absolutely adamant that this was a 2,000-year project, that this wasn't something that was birthed from a short order. And it also wasn't always just about money. It's about growing our sense of prosperity and who we are and how we're going to go about and work in the world, and also to develop a consciousness of sustainability so that what we can do is we can really spotlight what it is that we do as a teaching. The work that we do is spectacular. And when you look at the world around you at any given moment, you might think that maybe perhaps we haven't made very much progress. But the reality is that the changes that we see in the world, we've had something to do with regard to the consciousness that we've imparted to the world and around us. And the foundation is there as a long-term project. It's there to develop a foundation that will be able to maintain and carry our teaching into the future. For years, what we found is that we were basically living with the consciousness of hand to mouth, that there was a certain poverty consciousness that we had as we move forward. And we recognized and realized that it also had a reflection as to what we thought about ourselves and what we did in the world and how we provided in the world. And so, like everything else that we do in our teaching and in our organization, we set about growing the consciousness of our organization and growing the consciousness of the people who are the members. And to do that, what we discovered, or what we know, is that there is nothing in success like success. I remember years ago that the first gift that our center was ever given was a gift of the humongous amount of $5,000. And up until that point, for the first couple of years, we literally were living hand to mouth. We were wondering how we were going to pay the rent and how we were going to pay ourselves all the way through it. And I remember when the $5,000 came in that we had a board meeting, and every one of the trustees had 5,000 different ways to spend that money. They just adored the idea that we all of a sudden had some prosperity, and they couldn't figure out how we could get it out the door fast enough. And our accountant at the time was a member of our board, and I remember her saying, you know, you guys have to grow up. If you put that money aside right now, what you're going to do is you are going to provide a foundation. You are going to provide a stability in your life, which will change how this organization, how this church operates. And it's exactly true for our organization, our larger one. You know, that $5,000, I swear it's still someplace, I'm retired now, but it's still someplace within the coffers of the Center for Spiritual Living Kelowna. And it was from that $5,000 that everything else grew and developed. And it wasn't about the money, it was about the stability. It was about the appreciation and the understanding. It was about a sense of value that we had that grew and expanded and helped grow our center. So when we started talking about this 10, 12, 13, 14 years ago, and we started to envision what it would look like, part of that envisioning was the recognition and the realization that this was a 2,000-year project. And understanding that we have nothing better to do than to take this teaching out into the world and to develop it from that ideal and that idea. You know, we look at the wealth of the Catholic Church and say, wow, if we only had a portion of those assets, what could we do in the world? The truth of the matter is that started 2,000 years ago. So this is a long-term venture. And our committee and the people that participate in this foundation are doing it with that idea in mind. And that idea in mind is a spiritual principle. We're growing in to what it is that we want, what it is that we desire, and what it is that we know to be true. And so I'm happy to support it, and I'm happy to be part of this committee, and I'm happy to be part of CSL. And I most certainly bless and love and honor all of you out there. And it's so nice to see your faces. I'll turn it back over to you, Michael.
Thank you so much, Dr. Kent. It's always so great to hear from you. And it's really good to see you again, too, on one of our meetings. That's great. So next up on our agenda is Ray Marvin. Ray is a founding board member of the Science of Mind Foundation. And he's also a major donor to our foundation. And so we just wanted him to share a few words with you, a little bit about the beginnings of the foundation and how we've gotten to where we are. So without further ado, Ray.
Thank you, Michael and Mr. Chairman, Errol. It's good to be with all of you. Thank you for participating in this event. I'm very happy to see how much specific interest there is in the investment side of the Science of Mind Foundation. Maya Lin, you remember, is the American architect, designer of the Vietnam Veterans Memorial in Washington, D.C. She has a great quote. "If you don't remember history accurately, how can you learn?" And so Ken gave a little history there. My history goes back a little bit farther and maybe slightly off kilter, but in 1992, I went to my first Asilomar meeting and met Michael Beckwith and Bob Gale and many other people who were leading at that time, and got involved in the Holmes Institute Board of Directors. And enjoyed that service very much because it gave me an opportunity to meet and work with Reverend Michael and Christian Sorensen, Kathy Hearn, many of the people who you all know about. During one of the meetings, Walter Drew, who, as you know, chairs the foundation right now, the foundation board, Walter Drew and I were walking back to the headquarters of CSL, then at Reverend Arthur Chang's church. And I said, how is it that a teaching such as this that shows the way to prosperity and abundance doesn't have any money to run things? And he said, well, there's a little history. We had a lot of money, and the problem was that every time a bequest or gift of any size came in, it was spent. And so there was a foundation, but the foundation didn't really work because the powers that be wanted to spend the money that was in the foundation's coffers. So that really bothered me. It was very helpful history, and remembering it accurately, as Maya Lin says, is very important. So working with Kathy Hearn about this idea, I said, I want to give money because thanks to the science of mind, I was led to working in business and became the beneficiary of a considerable abundance. And I connect that directly with the teaching. And so I said, if there's a way that something can be done to get a foundation going that would actually have a continuing endowment that doesn't give away the principal, but just gives away or invests the earnings, I would be very interested. So Steve Burton and Kathy Hearn worked on this idea, as Dr. Ken was saying. And Kathy Hearn asked me to become involved in the beginning of it. And so I was delighted to be a board member at that initial phase. And so that's the background. The history of squandering is important to understand why we can't spend the seed corn. And so all I can tell you is that I think all of you are very wise to be thinking about the seed corn for your individual centers and investing it wisely. Now, the markets are going to go up and down, and the value of endowments is going to go up and down. But we all know that over the long course of history, and again, it's a long course, not necessarily 2,000 whole years at one time, but in the next 5 and 10 and 20, things will grow because that is the nature of the economy here in this nation. So that's a quick background, Michael, about my involvement and my motivation and a little bit of history.
Thank you so much, Ray. It's always good to hear from someone who does have that historical perspective and also understands the role of history in our lives today. And so it is with that I would like to now turn this over to Arrow Johnson, who is the chair of our investment committee, and Arrow will be giving the major portion of this presentation.
Thank you, Michael. And thank you, Ken and Ray. You can tell just the wonderful personalities and experience that I get to share. The responsibility of working with the investment committee and on this committee. I'm so impressed with Ray and Ken and Charlie as well, even though Charlie couldn't be here with us today. He's amazing, amazing fellow to work with, and just a phenomenal background in fundraising and in foundation management. So we're truly blessed in so many different ways, in such a meaningful way. I would like to take a look at both our Science of Mind Foundation investment performance, and then also address the allocation, why we have things set up the way that we do, take a little bit of a time and talk about our process. But I think it's really important for us all to be on the same page in terms of why things are set up the way that they are. And again, happy to answer any questions around this as we go forward. So our investment committee recommended and the board approved Vanguard as our discretionary investment manager. And Vanguard invests as a prudent expert on our behalf from a fiduciary standpoint. And they do operate in line with our written investment policy statement. And hopefully everybody's had a chance to take a look at that at some point as well. If you haven't, please reach out to Michael and he can provide you a copy of exactly what the investment policy statement is. And that is very much a living and breathing document. We review it on an annual basis, and we've done a full review and actually rewrite just 2 years ago. So it is something that we are constantly looking at and actively managing on your behalf. And as Ray mentioned, we do due diligence processes as well on a regular basis. We've done 2 full RFPs over the past 10 years. Vanguard has been the chosen selected investment manager as a result of those RFPs, but they are very thorough in their structure and how many firms that we reach out to from a national basis. So we do take this very seriously. And Vanguard has proven to be a good manager on our behalf, very low cost, very effective, very efficient. And we now have a long-term track record with them of almost 10 years. As of this September, it'll be 10 full years worth of investment performance. So we have the opportunity to look back and really have a pretty good, clear understanding of how things are done and how, the volatility has been and how this is in line with our investment policy statement. So we've had a lot of volatility, just to think about this, over the past 10 years in the portfolio, mostly up in the volatility, but some down as well. I'll tell you what, Michael, if you wouldn't mind pulling up the Vanguard statement, I think everybody got a copy of the one from the end of February, but we have some updated numbers here that are through the end of April. So wanted to go ahead and take a look at this and really show you how things are, as close to up to date here as possible. So just to set some context around here, again, a lot of volatility over the last 10 years. That really is how the equity markets work for the most part. And we also have a very long-term objective to invest for perpetuity. And investing is an activity where consumption today, as both Ken and Ray were talking about, is really foregone in an attempt to allow for greater consumption at a later date. And risk is the possibility that objective won't be achieved. The greatest risk to a perpetuity objective isn't the short-term market volatility or even a recession, it's loss of purchasing power over time. The value of money goes down over time due to inflation. And I've got a page that I'll cover on that here in just a little bit. But effectively, when your investment horizon lengthens, especially to perpetuity, a diversified portfolio of stocks and bonds becomes progressively less risky than cash and holding on to money like that. So this is the reason why we have and we're willing to take risk in the portfolio on a long-term basis. And we do currently have a portfolio of about 70% stocks to 30% bonds. Our portfolio is extremely well diversified per our investment policy statement, and it's diversified by asset class, by sector, by style, by capitalization, globally, or where the investments are. And this is done specifically to reduce risk. We won't get potentially as much returns as if we put all our eggs in one basket. We certainly have not put all our money into crypto to go up and down. We diversify to reduce the risk that given any market or asset class has outperformance, underperformance, we can spread that out and have overall less volatility than investing in any one specific asset class. And we're looking to achieve our long-term goals. So our long-term goals are to spend somewhere between 3 to 5% annually, adjusted for inflation. In other words, in today's value of dollars. And long-term inflation is about 2.5% over the last 100 years. And yes, that's including the last year and a half. And by the way, inflation was a lot higher in the 1980s, as we know. So our long-term return goal for this account from spending plus inflation is to achieve a return between 5.5 and 7.5% over long-term time annually. And you can see that the performance of the account itself has lived up to those standards. Now, of course, over the course of the last year was a down year in the overall markets, and we had performance that was negative for this last year. But even including that, now this year, of course, has been far brighter. Even including last year, as we look back, year to date, we're up 7% through the end of April. On a one-year basis, we're now positive through the end of April. Over the last 3 years, 8.2%, but most importantly, since inception, 6.65% on average annual compounded has been the return. So that's why it's really important to stay the line, to make sure that we're invested very diversified broadly, reduce those risks where we're able, but also participate in the long-term growth that is available in equities and in the bond markets. Now, just to put things, I think, a little bit in perspective here as well. On average, about 1 in every 5 years is a down year in the stock markets, and down years in the bond markets are far more rare. It's actually about 1 in 10 years, bonds actually lose some value. Typically, they do move in different directions, and this is why we do have a portion that's in bonds as well as the majority that's in equities. But last year, they did move both down in tandem, and that's only happened a couple of times in history. So it was truly a rare event that we had this last year. But again, we do know that markets don't only go in one direction. They're back to positive this year and over the past 1 year. Bonds as well, for losing some value over this last year, it's actually put us in a place where we now have productive yield again that's coming out of bonds. So bonds are actually paying higher interest rates at any time than in the last 15 years. In fact, you can go out right now and get a money market that has a yield of about 4.93%. When was the last time we had that? It's 2007. So it does pay to look over longer periods of time. We also feel much more confident in the growth of the portfolio over the next 10 years than it has been over the past couple of years. So wanted to show in terms of how things actually are structured in the overall portfolio, how we've done so far. And we have a great deal of confidence in Vanguard at this point as our investment manager and how the overall portfolio is structured from an investment standpoint. One of the things I'd like to do as well is just talk about why do we really have this long-term perspective and why are we willing to go ahead and take risk in the markets and not be more tactical? Why don't we shift out of stocks into bonds at certain points or into more cash at certain points? Why does it pay to have more of a static type of a long-term asset allocation and then manage to that over time? And so I've got some pages I want to be able to pull up. Michael, if you've got it available to be able to do the long-term presentation, I'd like to start us off on page 20 just to set some context here for what we're talking about when we take a look at inflation. As I mentioned, inflation is actually the single largest risk to a portfolio over time. So this is just giving you a sense, even since 1950, that the purchasing power of $100 has come down from $100 in 1950 is now the equivalent of less than $9 in today's dollars. As a matter of fact, if you go back just another few decades from that, starting in 1930, $1 in 1930 is now worth about 4 cents in today's purchasing power. That is really significant, and that is the single largest risk to having long-term investments. And this is really the reason that we have to have equity types of investments and things that can actually outpace inflation over time, along with allowing returns or allowing spending on a yearly basis, and to actually grow the corpus. And this is really the whole purpose of what a foundation is set up to accomplish. As I was looking back on this, I thought this is kind of interesting. So I did a little review just to see, so what does that actually mean? In 1923, so exactly 100 years ago, you could go out and buy a brand new Chevy Roadster for $570. Eggs were about 13 cents a dozen. You could go buy a luxury large house for $7,000 if you wanted a huge estate, a country house with 13 rooms and 2 barns, about $20,000 in those prices. To rent a house, $55. To spend a week at the YMCA was $4. A movie would cost you 17 cents. And the average hospital overnight stay was about $12. So try to think about that last one in terms of what it might cost you to spend a night in the hospital today. And this is really why we need to keep up with and outpace inflation over time. It is constantly nipping at our heels. We all feel the impacts of it over the past 2 years. And we've seen really inflation come out from the pandemic. And now that that's starting to come back down again, it's a good thing to see this start to come down, but we have to be able to outpace this over time. Over the last 100 years as well, just to give you a sense of how things have done. So the dollar has had a negative 1.4% real return on an annual average basis, and that's what you're seeing in this graph right now. Gold has gone up by about 0.6% on average annually. Treasury bills have gone up by about 2.5% annually, bonds by about 3.5% annually, and that's pretty decent. But stocks have been the real clear winner over the last 100 years. They've gone up, and these are all after inflation returns. So after the effects of inflation have been taken out, stocks have gone up by 6.7% on a real return basis after inflation adjusted over the course, on average, annual compounded over the course of the last 100 years. And that's why we really do have things set up to be a little bit more on the equity side. I tell you what, if you want to take us back to page 2, and I'm going to run us through this fairly quickly here at this point. So I do want to say, obviously looking back, the U.S. economy has periods of strength and weakness. The recessions do come in. But if we take a look at the GDP of the overall U.S. economy, we do see much, much longer periods of growth than contractionary periods. If you flip to the next page, you'll see that this correlates highly with the performance of the equity markets. So you can see that we do have bear periods. Bear market periods are really defined as those periods of time when the stock market can go down by 20% or more in a given time period, and how long those can potentially last. You can see by far the longest was the Great Depression back in the early 1930s. But look what happened coming out of that. We had 167 months with a cumulative return of 815% total over that course of time. So our periods of growth far, far exceed the periods that we have down in the markets. And again, it's just helping to maintain our long-term perspective associated with it. If you flip over to the next page, stocks do tend to rise, of course, over long term. As I mentioned, the average annual return 6.7% above inflation over the course of the last 100 years. Since 1950, you can see again, 79% of the time, stocks are positive on a year-over-year basis. About 1 in 5 years is a negative year. I used to have a brick on my desk that said 1 in 5, ask me why. And invariably, at some point in the conversation, people would say, okay, what does that actually mean? They'd say, well, stock markets are positive about 4 out of 5 years, but 1 out of those 5 years, you're going to want to take the brick and throw it through a window. But just remember, when you really want to throw it through that window, reach for your wallet at the same time, because that's the single best time to invest, is when it feels fearful. These are going back to Warren Buffett. As a matter of fact, just a quote from Warren Buffett for a moment. He came out and he said, hey, in terms of taking a look at market fluctuations and putting that into perspective, the markets are generally rational, and this is his words. They do occasionally go crazy. Seizing opportunities then offered doesn't require great intelligence, doesn't require a degree in economics or familiarity with Wall Street jargon such as alpha and beta. What investors need instead is the ability to disregard mob fears and enthusiasms and focus on a few fundamentals that are simple. A willingness to look unimaginative for a sustained period, and maybe even look foolish on the short term, is also essential. And this is the ability to not get caught up in the day-to-day of what's happening in the markets and maintain that long-term perspective. If you want to flip us over another page here, we'll go over to page 5. I think this one is really helpful to take a look at how often do we have positive returns on a rolling basis. in a more diversified portfolio. So if we can take some of that volatility out of stocks by diversifying just about 40% into bonds, then what you see is that on a 5-year rolling basis, actually a diversified portfolio has been positive nearly 100% of the time, 99.6% of the time since the 1950s. And on a 10-year basis, it's been positive 100% of the time. So, but on a 1-year basis, we do find that we have some periods of volatility, that it's going to come down. And so this is what we want to be thoughtful for, why we want to maintain our long-term perspective. Just 2 more slides and I'll wrap us up. And then I want to bring us into questions so that we can actually talk a little bit about it. Thank you. Yes, page 8, that's exactly it. So what I do want to highlight is that as we're living through this on a yearly basis, it's hard not to react because we see the volatility played out in real time in the markets. All of us have iPhones or have Androids that we're looking at constantly. We have CNBC going in the background. Every time we turn on the news, we catch the headlines. So we're very, very keen in terms of what's going on real time at any given moment. Right now, we've got a debt ceiling. We've got a Fed that's been hiking rates quite a bit out there. There's a lot of fears that are always built into the markets, and there's volatility that comes with it. As you can see, and this is every single year listed out over the last 40 years, about what were the lows in that particular year? How much did the S&P draw down at any given time? And what's interesting is that you'll see about 2/3 of those years, we actually had drawdowns of 10% or more in the S&P 500. But of those years, actually 2/3 of those years still finished positive. We experienced this firsthand during the pandemic just 2 years ago, or 3 years ago, in 2020, when we had a drawdown of 34% in just 1 month. That was a radical. And then yet the stock market still kept going and returned positive by 18% by the end of the year. That's a huge turnaround, and that's not an uncommon type of a thing to have over time. The volatility is simply that price of admission to be willing to put the money into stocks. We have to maintain our sense of perspective, what our goals are, and what we need to do. The goals of any account are always lined up with exactly what that allocation needs to be to meet those goals. If we needed all the money tomorrow to be able to spend it, then investing in stocks wouldn't be the appropriate way. But this is a perpetuity account. We're here to provide support for the Science of Mind Foundation forever. We want to see this grow forever. That's what our donors want to see, who are putting money into this as well. They want to see this grow, continue to thrive, and provide a solid backdrop for ongoing spending at greater and greater and greater levels forever. So it's hard for us not to get caught up in the day-to-day, I understand, but it is really important that we go ahead and keep that long-term perspective. And then I think probably page 16 is probably the place to take us out here. This is really, again, if you go down to, this is what the returns have been of diversified portfolios over the course of the last 70 years. So from 1950 to this last year, including this last year. I'm sorry, we want to go down to page 16. There you go. So this is really showing you if you were 100% stocks on the left, all the way over to 100% bonds, what were your best returns and your worst returns on a yearly basis, and what were the average over time? And this is where we firmly sit at 70% stocks to 30% bonds. On a long-term basis, over the last 70 years, it's actually been about 10% has been the return. Over the course of our experience, it's been right in line with our long-term return goals, which is about 6.75%. But over time, it's even been higher than that. These are the reasons why we're taking out some of the volatility, but we want to experience that growth over time. We want to have some more stability for the spending on a yearly basis and balance that out with meeting real long-term return targets. And with that, that's a lot of background, a lot of information, a lot of context there. But I wanted to give a sense for why we have things spread up the way that we do and why this isn't powerful and impactful, and how things have actually done over the last 10 years. So we're very proud of the Science of Mind Foundation and of all of you for how you've brought in the funds, for how you've interacted with us, and really allowing us to work with you in this kind of a capacity. It's such an important mission that we have as an organization, and we're really happy to be, working this in the right way for you. So, and with that, I think I'd like to go ahead and hand it back to Michael, and let's open this up for questions. And if there aren't a whole bunch of questions, we can give a few minutes back as well.
Very good.
Michael?
Yes, Errol, first question. How is the annual distribution to a center handled if a center decides to take the annual distribution? Is it considered a return on capital or investment income?
That's a great question. So it's basically a distribution. So it's not, trying to think from a tax perspective. I think we'd actually have to ask our accountant specifically from that. But as a 501c3, as a nonprofit organization, there shouldn't be any tax consequences, and there aren't tax consequences associated with it. We look at things from a total return perspective. So we're not looking at just income or of capital gains. It's the total returns of the overall portfolio. If you were an individual, there would be tax consequences associated with that. But as an institution, there shouldn't be any tax consequences on that. So I would imagine this is an accounting question. And Michael, you may have some insights on this as well.
I do not. I would also have to consult with a tax professional on that.
Okay. I work with quite a few religious organizations and centers, and I've never had any issues associated with this, and never any tax consequences, just from a personal standpoint. Yes, sir.
Okay, next question. How does the fund diversity reflect science of mind principles to things like sustainability, ethical, socially conscious businesses, national and international businesses?
Well, it's a great question. I'm not sure, Ray or Ken, would you like to jump in on this as well? But I'm happy to. I don't want to answer every question, and I know, Ray, you've got a lot of insights on this as well. Do you want to jump in? Oh, you're on mute, Ray. Still on mute, Ray.
There we are. Okay, thank you. This is a fair question because it's actually been considered by this committee several times over the years. And the debate takes this shape. One person's preferred investment may be on another person's no-no list. For example, nuclear power. Is that a good investment, ESG, or a bad investment? Is it environmentally beneficial or environmentally damaging? There are so many debates about whether a company's corporate plan, the product mix, the service mix, has a benefit to society beyond just making money for the company. So having debated that, and that debate can go on for a long time, half hour, hour easily, with all kinds of interesting examples. The conclusion reached that I recall, Errol and Michael, is that we should stick to the idea of making an investment in the broadest possible way through the buying the stock market, if you will, concept of the broad indexes rather than trying to pick individual stocks and avoiding individual stocks. That gets us into the decision making from time to time as to what company to buy, what company to sell. We don't have the expertise on that. And we have turned to Vanguard, who has our expertise. And it is their recommendation, I think we enthusiastically embrace it, that the best way to deal with this when you're talking about intention is to try not to play favorites or unfavorites and to try to diversify very, very broadly across the economy.
Well said. It is one of the things that we do continue to look at on an ongoing basis as part of the investment committee, and this does come up on a fairly regular basis as well. I think, as we're all aware, the socially responsible investing, environmental social governance, diversity, equity, inclusion, those types of things are becoming more and more part of the investing world. It's really only about over the course of the last 10 years that we've seen more and more opportunities come up to have investments in that way. 10 years ago, there weren't very many options for SRI investing, and they simply don't have a long-term track record associated with them in a lot of the sub-asset classes. So it's hard to have an extremely well-diversified portfolio that's still representative of certain standards in ESG or in SRI. So I think there's the part that Ray was just talking about, which is it's hard to define as a larger group. It's very easy to define, or much easier to define individually. It's harder to do this as a larger group. Number two, it's hard to identify the correct types of investments to get a full, well-diversified portfolio that have a substantial track record. And then a third aspect of it as well that we've really discussed is if there is a potential for less return for the same amount of risk that comes along with ESG or SRI investing, is it our fiduciary responsibility to our donors, to those who have entrusted us with the money, and to the overall Science of Mind to make those types of trade-offs to take less return for the given amount of risk? Or is it better that we get the full amount of risk return and then use the proceeds from that according to our Science of Mind determinations? So that's really, as we've talked with the board about this and talked with the investment advisors about it, we've landed so far on we want to maximize the risk-adjusted return profile of the overall portfolio and then use those proceeds to further the Science of Mind Foundation causes. So that's really our answer at this point, but it's a really good question. There's more opportunities all the time. There is better track records that are being developed. We want to continue to pursue and look into this as we're going forward. We just want to be very, very thoughtful about how we're doing this as well and make sure we're answering a lot of those questions. But we encourage all of your thoughts and feedback on this as well, and what you're hearing as well from donors potentially too. So thank you, a great question.
Great. So our next question is, within the U.S. equities, can you talk about our goals and the resulting portfolio mix?
So within U.S. equities specifically?
Yes.
Okay. Well, again, so we're looking to, what we're using right now is we're using through Vanguard some very broad asset classes. So we have given Vanguard some specific parameters in terms of here's how we want to be invested. We want approximately 70% in equities. We want about 30% in fixed income. And we would like, and here are our return targets associated with it. So really our return target that we've listed in the IPS is effectively we want to be about 5% plus inflation, but we know realistically that's between about 3 to 5% plus inflation. So a real return target of between 3 to 5%. We are giving you the discretion in terms of how the structure is to broadly diversify, to meet those return targets, but with the minimum amount of risk associated with it. So what Vanguard has done is they've used broad market indexes. Vanguard is rather famous for creating actually broad market indexes to a great extent back under John Bogle. And they use very cost-effective indexes that are associated with the S&P 500 or Russell 3000, and then globally on what's called the All Country World Index. So our portfolio is generally structured to the All Country World Index, and that's separated by capitalizations, which is size of companies. So we've got predominantly large cap, large size companies, mid-size, smaller tier, and then small companies. We do have an allocation associated with that, but they're structured by capitalization of how they're represented in the overall global index. That also goes on a domestic versus international basis. So we have a higher weight towards the US, slightly overweight to the US than we do internationally. And this is basically represented over through the portfolio. So, but this is at Vanguard's discretion. We talk with them about it, talk about which ways they're leaning. They're not using things on a tactical basis. So they're not making major adjustments on a year-over-year basis. They're doing this on a long-term capital market assumption structure. So they're looking out over the course of the next 10 plus years and saying, based off of historical precedent and where we see things going over the course of the next 10 years, we're optimizing the portfolio to these parameters. So they're looking at long-term, which is in line with our thinking as well, and adjusting the portfolio. Then, as we do have market volatility, that takes the portfolio out of that 70-30. So stocks rise this year a little bit more than bonds. If we get to a drift of more than 5% up and down, they will automatically rebalance us to our target allocation. So they're forcing the portfolio to sell high and buy low, which is exactly what we want to see happen. So they're forcing a prudent process into the investment performance and structure of the allocation. So I'm not sure if that helps from an overall, but we're broadly structured to match the overall all country world index that Vanguard is structured on our behalf, or Vanguard is put together on our behalf. Did that help? Was that or were there more specific questions kind of behind? That's what I wanted to get to.
So, and that is actually, Errol, the end of our questions that have come in through the chat. And so, do you have any parting words for us, Errol, of wisdom?
Parting words of wisdom. I would just say, again, my dog definitely has some parting words of wisdom. I've got a giant German Shepherd Husky mix that's thrilled when retirees come. What I would say is that, you know, we're here to work with you and to be responsive. We want this to be a solid working foundation for all of us, for all of our donors, and for the movement on a long basis. So we want to hear back from you. As you do have questions or thoughts or input that you would like to share, we'd like to hear that on our committee. And we'd also like to continue having these kind of, you know, roundtable meetings on an ongoing basis here as well, at least annually. I think we've been fairly good at that so far, but, you know, if there's more or less that's helpful, please let us know. So we just want to be, you know, we want to be very transparent about how we work and how things are structured. This has been a great success that we've had on a long-term basis so far, in spite of the volatility that we've seen. We want to continue the partnership, and we'd like to see this grow to many more centers as well. We want to make this a real thriving type of a foundation for the entire movement, and we're very excited by the success that's had so far over the course of the last 10 years. And I mean, this is just such a personal mission to all of us that are on the call today. So we want to see this grow and work for everybody. Very excited to be working with all of you. So thank you.